Welcome to the Vaughan Nelson podcast. With me today is Deputy CIO Adam Rich. Welcome, Adam.
Hi, Dan. Great to be here.
So Adam, over the last few quarters, we kicked off a new podcast series. We described it as the Winners and Warning series, where we looked at some specific industries and looked at capital flows and some companies inside of those specific industries. And our next venture now, it's what we're calling the benchmark blind spots. And the real premise here is that most investors think that benchmarks are neutral, right? And what we're going through here today and where we start today and where we're going with this is really to display that they're not. And really the idea here that every index embeds some assumptions, right? Whether it's risk or return or where capital should go. Those assumptions, they very much shape the outcomes and they very much do so more than a lot of folks realize. So in this series, our goal here is we're going to look at benchmark by benchmark, and we're looking to expose some of those what we describe as blind spots. These spots that investors they're inherited when they default to a passive investment or a passive exposure. So we're going to look to explain what is actually driving the returns beneath the surface of those benchmarks. And today, with that, we're going to kick off with emerging markets. So then let's just jump right into the first question. First one I got for you. So many allocators they start with the emerging market index as essentially a neutral baseline, right? And looking at some of the work that we've done here at Vaughan Nelson, looking at some of the work that you and your team have gone through, it suggests that the index itself embeds a long set of bets, right? What the question here? What are investors implicitly signing up for when they default to a passive investment inside of emerging markets?
Yeah, when investors think about investing in emerging markets, they typically think of countries who have exceptionally high levels of growth. But when you look at the index right now, what's happened is that index has gotten as concentrated as the S&P 500. Just to give you some data, the top 10 of the emerging market index is roughly 31%. The S&P 500 is 38%. And the Russell 2000, just to give comparability, the top 10 is 5%, right? So these indices have gotten very concentrated. And I would make the argument that EM is even more concentrated because those top 10s are really focused on AI infrastructure. And interesting, and just a fun fact, there is a 13% weight in this passive index. So, you know, if a investor is looking to get diversification outside, in emerging markets, the passive index does not give that to you.
So you describe emerging markets as being defined as capital constraint. What does that actually mean in practice, and why does it lead to such a narrowing group of companies driving long-term returns?
This is the key difference between developed markets and emerging markets: capital availability. Right. In developed markets, if you have a project that earns a high return, you can go get capital to do it. In emerging markets, that's not true. Uh, Currency regimes, interest rate regimes, policies, political cycles, all of those things create for different levels of, of capital availability. And the reason why that's so important is when you look at the index, what you see are a few companies who have the ability to invest at very high rates of return and have access to capital. And then you've got a whole bunch of companies, hundreds of companies, who don't have access to capital, are not investing, are just trying to survive. And so that creates for very wide disparity in the index.
So one of the things that stands out to me is the point around concentration and that it's not temporary, right? It doesn't last forever. Um, but how do you think about this one? How is a concentration? How is it earned? And then maybe more importantly, when does it start to unwind?
Yeah. So what's interesting about the EM index is 20 years ago, it was concentrated too, but just not in technology. Uh, Energy was almost 15% 20 years ago, and materials was very high, and financials were actually, had a very, very high rate too, high percentage. And so concentration is not uh, it's not unique in EM. This happens, and it's because of capital scarcity. And so the way that we approach this, right? And I know this is a big buzzword right now, but what are the first principles to investing? Well, in order to grow, you have to you have to have access to capital. You have to be able to invest it, and it has to earn a return. And when that happens, you can grow your earnings, and your stock price will go up. And not everyone can do that. And so what happens in EM is there's big scarcity moments, and then there's big abundance moments, and that creates for these boom busts and these big cycles inside of EM. And the capital allocation framework is all about identifying those first principles and seeing who's investing and who's not. And this way we can identify, well, who's earned the right to be concentrated and who's not. And that's based off of the investment levels and the returns.
So a lot of what we're talking about specifically is around this concentration. If so much of the emerging markets returns are driven by just a small number of companies, why can't you just simply own the largest names in the content and the index? Why don't you think that's sufficient? And then, what does the index get wrong about that type of concentration?
Yeah, this is a really important part because of the way the indices are built and market cap is a big determinant. There are scenarios where a country's policies uh, can create for very companies with very high market caps, and it's not earned. It's all because of liquidity, right? A big example of that is what's going on with China. There's not a lot of places for capital to go, and so a lot of them flood into the large companies, even though those companies, every dollar they put in their business, they actually get lower returns. And that's been the trend for the past 15 years. And that's just because of where liquidity is forced to go because of that economy.
So one of the points you make in a concentrated index, that the real risk isn't specifically the concentration itself, but more importantly, maybe it's just being wrong about your concentration, right? Why does passive struggle so much with that distinction in emerging markets?
Yeah, this is a great time to be talking about this because memory, which has always had a decent weight in the emerging market index because of the Korean companies, Samsung and SK Hynix. But they have had exceptional moves because memory has been short supply in this AI supply chain, and has been now for about 12 months and is projected to be supply constraint. And these stocks have just absolutely ripped. And now they are so big that it represents about 7% of the index. So if you're buying the index right now, how many investors are sitting there saying, okay, I am taking a 7% bet on memory because I think that's a good idea over the next, few years? Most likely none. Most likely what's going on with emerging markets is, oh, I want exposure to growth because right now we're moving into a pro growth cycle. Well, that may not be exactly what the investor is signing up for. And so what we really care about is finding companies who have earned that level of concentration. And if they haven't earned it, or if there's a whole bunch of capital coming in to try to solve something like right now there is in memory, does it make sense to own those names to begin with?
And for a lot of active managers, thinking about the flaws that exist with passive, more often than not, they end up just combating those by adding more names instead of concentrating it down into fewer. Um, Specifically in emerging markets, why would that instinct for an active manager backfire?
That's it's really interesting because it actually ends up being more risky the more diversified you get in EM, because what happens is your risk is actual underperformance, and you're not owning enough of the names that really matter. And to break it down into factor terms, because we do look at the benchmarks in factor terms, right? The index for EM may only have a few factors, but if you own 100 names, you probably have 20 factors or more represented in your portfolio. And so what happens is you're way more diversified than the benchmark, and so you're actually taking a big factor bet by being more diversified.
And then so allocators diversify across multiple active managers. Each one of those they make some type of an effort to be broadly diversified. Um, how does that layering of diversification affect outcomes in a market specific to something like emerging markets?
Yeah, look, this is an industry norm right now. If you're going to go active, you're going to take a few managers to try to diversify your active risk. But what ends up happening is you dilute down the holdings, and you're very likely to not own enough of the stocks that really matter. And we all know the stock market is a positive skew game, right? Just a handful of companies drive the majority of the returns. And that's true everywhere. But in particular in EM, it's very pronounced because of the capital scarcity issue. So the more active managers you have, the more likely you're diversifying away from the stocks that really matter.
All right, so we're sitting at a situation where passive fails, dilutive active fails. Walk us through what's it actually take to compete in a concentrated index, something like EM. And then if I'm an investor, how am I thinking about concentration, the proper way?
Yeah, see, you have to be concentrated in order to beat this benchmark. And it's not just about being concentrated and just owning the top names. It's about owning the names that are investing and appropriately that are going to generate future returns and avoiding the industries that are attracting too much capital, right? Because emerging markets, most of these companies are dealing in commodity industries. And so once capacity comes, it torches that market for years. And what happened in memory, just to use another example, is a few years ago, Samsung really missed the ball, cut significantly, hasn't invested as much, and that created for this big issue we're in right now. But fast forward a few years, there's Chinese competition coming. There's a lot more investment coming. A lot of these issues can be solved, and so the most important thing is you have to be concentrated to beat a concentrated benchmark, but then you have to be able to know what names to own. And that's what the capital allocation framework does so well for us, right? It helps us navigate where to go and avoid the industries that are seeing too much capacity. And those tend to be the stocks that have the biggest weights.
Okay. All right. So tying this up, the challenge here is emerging market. The challenge is within emerging markets is trying to avoid dilution, but staying concentrated in the right names. With you at Vaughan Nelson here, when you're as a portfolio manager, as your actions, what is your approach? What are you doing? What do you see that's differing from peers and in the group?
At Vaughan Nelson, we build high active share portfolios. We are not sitting here under and overweighting things by 100 basis points, right? We are taking deliberate investments, and we are in companies who are investing, making good investments that are going to drive higher return on invested capital over time. And we are avoiding the industries where there's too much capital coming in. And because of that process that we have, we're able to build a high active share portfolio that will outperform all these indices.
All right, last one I got for you. One thing that you could share with some allocators to understand how you're thinking about the approach and approaching emerging markets after our conversation. What would you leave them with?
Concentration really matters. But two, I really want to emphasize the capital constraint nature of emerging markets. Because capital is so constrained, it creates for these big uh, divergences in the companies who can invest and the companies who can't. And that creates for huge alpha opportunities in emerging markets. And right now, we're seeing a huge difference between the companies who can and can't. But there's also a lot of changes going on structurally that are creating for new opportunities for a lot of new companies in emerging markets. And we're excited about those. But then the capital allocation framework is really the tool that helps us drive that.
All right, good. That's it. So first benchmark blind spots. I think that's a good one. Look forward to see what you cook up next.
Great. Thanks for having me.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.